Hello everyone, welcome to another video with Professor Choi. Today we're going to have another conversation about investing for beginners, and this is another answer to a question from a student. So the question from the student was, what is a stock split or a reverse split, and how does it affect the value of the company? In other words, is it diluting the amount of stock that I have or something of that sort? So a split or a reverse split is something that companies do, I wouldn't say regularly, but we see it in the market all the time. And the reason companies do it is because they want to either lower or increase the price of their stock. So a split basically increases the number of stock shares available, but it lowers the price proportionately, so it doesn't really dilute your stock ownership on that company. In other words, it doesn't really have any fundamental change in the value of the stock, but it does make the price change, and it makes the price look cheaper if you split. Alright, now a reverse split decreases the number of stock shares available, but it increases the price proportionally, so it doesn't dilute your stock ownership. Okay? Now, to be able to kind of think about what a split or a reverse split is, I think it's better if we do a couple of examples. You need to remember this formula here, which is basically the market cap, or the total value of the company in the stock market, is equal to the number of shares available times the price of the stock. And let's put an example there so that we can understand it. So let's say that we have a company that has 100 shares. Each one is $10 each, and therefore we have a market cap of 1,000. Okay? So, simple example. Now, let's do a split and see what it does. So, let's say that we're going to do a 2-to-1 split. Alright? So, split 2-to-1. Alright, now what does that mean? So what it basically means is that every one stock is going to become 2. Alright, so instead of having 100 stock, we're now going to have 200 stock. But the price of the stock is going to be reduced proportionally. So because the stock used to be $10, we're now going to divide that by 2, and it's going to give us $5. So my split is going to turn my stock into 200 shares available at $5 each, but it maintains the same market cap. In other words, the company is still worth the same in the stock market, so it's still worth the same as it did before, but now you have more shares available at a lower price. Now the reason companies state that they do this is because they want to make the shares more available, and that usually means to retail investors. Apple has done it plenty of times in their lifetime. Tesla has done it a few times in their lifetime, and lots of other major companies have done it in their lifetimes, depending really on where the stock is at any point in time. But anyway, this is usually the reason. So the reason is usually to lower the price of the stock so it becomes more available to people. Alright, now let's take a look at what a reverse split is. So let's start with the beginning again. So let's say that we have again 100 shares, $10, and market cap of 1,000. Okay? And we're going to do a 1-to-2 reverse split. So we're going to do a reverse split 1-to-2. Up. Alright, so a reverse split 1-2, what it basically means is we're going to lower the number of shares available by half. So we're going to take the 100 divided by 2, and we're going to have now 50 shares. But then the price of the stock is going to be raised proportionally. So now we're going to be 10 times 2, or $20 per share. So if we have 50 shares, but at double the price, we still got the same market cap. So a reverse split doesn't do anything, again, to the fundamental value of the company, but what it does is it makes the shares look more expensive or more worthy. Now, why would somebody want to do that? Okay? Their biggest reason, by the way, is because the majority of the people that buy in the stock market, regardless of what you hear in the news, regardless of the talk about Reddit, regardless of the talk about the retail investor, 90%, and that's basically the majority of people in the market are basically the top about 5 to 10% of investors in the US. The top 1% of investors basically own half of the stock market. And the top 20% own about 90% of the stock market. So basically, the super wealthy and the funds that they manage are the people that are really mostly trading on any day-to-day basis. Okay? So if 90% of the market is owned by those people, a lot of those funds have like a minimum threshold for lots of the stock that they buy. So they have like a minimum price. And why do they set up this? Well, because usually companies that are quote-unquote more respectable have a higher price, and companies that are quote-unquote less, they have a lower price. So if your company all of a sudden wants to look better to these institutional investors, one way to look better is to look more worthy or more expensive, and therefore you tend to do reverse splits to do that. Another reason to do a reverse split is because there's a minimum price that your stock needs to be traded at in order to be listed in the major exchanges. So if your price drops below a certain amount, you will have to do a reverse split to bring it back up to that minimum threshold level. So companies that are doing really, really bad and their stock has now become what they call a penny stock, then you have to change and do a reverse split to get it out of that threshold so that it stays listed where you are currently being listed. Alright, now what are some of the key takeaways about what I just said? So a split or a reverse split doesn't really change anything fundamental about the stock or the company or anything at all. It really only changes the perception of whether something is cheap or whether something is worthy for an expensive investor. If you don't understand what I'm trying to say, by the way, look at the most expensive stock in this US stock market today, symbol RBKA. Alright? And that stock will tell you what worthy means to really wealthy people. By the way, if you're interested in buying some of that, they have a cheaper one of that, which is RBKB. And what it really is, by the way, it's like one of these split into a bunch of pieces. Okay? But anyway, I hope you learned a little bit more today about investing for beginners and what is a stock split or a reverse split. Remember, if you like this video, like it and subscribe. Thank you for choosing Professor Choi. Have a good one.